I want to start by briefly reviewing two of the most common retirement accounts you probably have: a traditional IRA and a Roth IRA. Think of it this way: with a traditional IRA, you get a tax deduction now, but you pay taxes on your withdrawals in the future. We call this pay taxes later. With a Roth IRA, you pay taxes on the money now, but all of your withdrawals in the retirement are completely tax free. A Roth conversion is simply the process of moving money from your pay taxes later bucket, your traditional IRA, into your pay taxes now bucket, which is your Roth IRA. The price of admission to this tax-free world is that you must pay income tax on the amount you convert in the year you make the conversion. So why would a retiree consider doing Roth conversions? The benefits are a major reason why this strategy is so appealing. A Roth IRA has no required minimum distributions, or RMDs, for the original owner. This is a huge benefit because it gives you complete control over when and how much you withdraw. All right, here are four compelling reasons on why Roth conversions make sense. Number one, no RMDs, which is a big bonus. Number two, it's completely tax-free. The money you withdraw will be tax-free. It will never be taxed again because you already pay taxes on it. It's a hedge. Roth conversions is a powerful hedge against rising tax rates. If you believe tax rates will be higher in the future, it makes sense to pay the taxes at today's potentially lower rate. And four, the RA is an excellent legacy tool. Inherited Roth IRAs are tax-free for your heirs, which makes them a powerful way to leave tax-free gifts to your beneficiaries. Now, is the Roth conversion right for you? Well, it's not right for everyone. It's a decision that requires careful thought. You should ask yourself these three key questions. One, do you have the cash outside of your IRA to pay the tax bill? You never really want to use money you're converting to pay the taxes. This will defeat the key advantage of doing conversions. Second, are you in a low income year? Perhaps you just retired, or you're a few years away from starting your Social Security benefits. A low income year could mean low taxes, and it's a prime opportunity to convert at a lower tax rate. And three, do you expect to be in a higher tax bracket later in retirement? This could happen. This could happen due to large RMDs or other sources of income. So, if a Roth conversion makes sense, this will be an excellent move. Now, there are two big issues you must be aware of. One is IRMA. What's IRMA? Well, IRMA is Income-Related Monthly Adjustment Amount. We'll talk more about that in a minute. Then two is your conversion tax. The Roth conversion is an immediate taxable event. Doing Roth conversions after age 65. Well, if you're currently enrolled in Medicare, you must be aware of income-related monthly adjustment amounts, or IRMA. That's the next common for it. It's called. IRMA is an additional premium surcharge that Medicare adds to your Part B and Part D costs if your income exceeds certain federal thresholds. This is critical because doing a Roth conversion will increase your reported income for the year the conversions occur, possibly pushing up your modified adjusted gross income over the threshold and triggering that costly IRMA surcharge 2 years later. All right, let me give you an example. This will help. Let's say you're a married couple filing jointly and you have an income of 200,000. That means you'll fall into this area on the table. So the Part B and Part D amounts appear on the screen here. So you'll be 185 a month for Part B, and your Part D should be around zero, depends on your insurance plan. That's the minimum amount that people pay for Part B. Now, what happens if you decide to do a $25,000 Roth conversion? That sounds great. Hey, we're doing a conversion. Well, now this brings your income up to over 212,000. It brings it up to 225,000. And this pushes you up over the cliff, we call it, into the next IRMA bracket. And look at what happens here. So now your total is no longer 185, it's 259. Because what it is, it's 185 plus $74. That's your IRMA surcharge. And for your Part D, you have a surcharge of $13.70. So please note that the IRMA you pay in 2025 is based on your 2023 MAGI income. And this is kind of complicated, but we will go in more detail on this in lesson 7 when we talk about Medicare. Well, all the pieces of our financial planning in this course now starts to fit together. It's important to realize the importance of tax planning and IRMA planning when doing Roth conversions. IRMA will be discussed in more detail when we do Medicare lesson, which is number 7. In addition to being aware of IRMA when doing Roth conversions when you're over age 65 and on Medicare, there's another major topic that needs your attention, and that will be paying taxes on the conversion. Remember, a Roth conversion is essentially like getting a massive bonus. The full converted amount is added to your income and taxed as ordinary income. This tax is due in the same year as the conversion. If your regular paycheck or income from that you're gathering and your withholdings don't cover this large spike, you can be faced with an underpayment penalty. The IRS is pay as you go, and they penalize for underpayment. All right, here are 3 key planning takeaways. 1. Pay the tax separately. You must use cash from a regular bank or brokerage account to pay the conversion tax. Do not pay it from the IRA itself, or you'll lose a portion of that tax-free growth, and you also may trigger an additional penalty if you're under age 59 and a half. 2. You may need to pay estimated payment taxes. Calculate the tax and send it in using the quarterly form. I think it's form 1040 ES, or pay it online. Use the online feature. Let me give you an example. You need to align your payments with the conversion income. For an example, if you're in the 22% tax bracket filing jointly and you make a $40,000 Roth conversion, you could just pay 22% of that $40,000 in your estimated taxes that particular quarter that you execute the conversion. And three, if you convert late in the year, be proactive. The IRS assumes income is earned evenly throughout the year. If you did a big conversion in December, you may need to file another form when you do your taxes, and that could be Form 2210, to prove the income was not earned evenly, preventing a penalty on your earlier tax quarters. Now, you may need to go to a tax preparer to help you with this form. Your tax preparation software should be able to help you preparing your taxes. However, if this is the first time you're doing Roth conversions, and they're large ones, it may be good to get some professional advice.